Okay, welcome everyone. We've now arrived at actually very late in the lecture, we've arrived finally at one of the most important parts in banking, which is to say regulation. Regulation and supervision. As you can see, we'll talk a lot about Basel I, Basel II, Basel III, the minimum requirements for risk management, and why is that? I think last time I already told you that we are still in the realm of economics, operating in a free market. So every time we start to regulate firms and we start to supervise firms, there needs to be a pretty good justification for that. Otherwise, we are just harassing firms which should be left alone. With banking, it's different. Banks need to be regulated and supervised for several reasons. And I'll give you the most important reasons just in a nutshell. Consumer protection. Consumers have to be protected from being unduly exploited by banks and financial institutions. Financial stability, because banks are vital for the proper functioning of the payment mechanism, of its payment services. The banks have a systemic relevance, and because of the systemic relevance, we need to make sure that they do not simply fail as would other firms do. And that's basically it. You can also say that banks have an important function in an economy because of their lending business. They give out loans, and loans allow firms to invest. And if firms are investing, we create employment. So you can draw a direct line from bank lending, firm investment, higher employment, lower unemployment. So again, systemic relevance of the banking sector, and thus a reason why we should make sure that the banking system as a whole is safe. Still, individual banks may go bankrupt. We don't prevent this, and we allow for this, but the banking and financial system as a whole should be safe. That's one of the main objectives of financial regulation and supervision. So, well, let's talk about the theory of banking regulation, the regulation of systemic risk, and how all of this has evolved over time, at least in the European Union and a little bit in the United States. So we should at first explain why we regulate banking in the first place. And one problem is that if we assume the banking system and the financial system, and in the following I will use financial system and banking system synonymously. If we assume the banking system as a whole is systemically relevant for the proper functioning of the economy, it also implies that if there is something going wrong in the banking system, and if we don't, as a society, if we don't want the banking system to fail, the government has to step in, and the result will be a bailout. Government will bail out banks. Government or the central bank will pay for the losses of banks to stabilize the financial system, and this will ultimately induce a moral hazard problem. What is moral hazard? Who can explain what moral hazard is, in contrast to adverse selection? Adverse selection and moral hazard are the two problems that might arise in case of what? Of asymmetric information among economic agents. Adverse selection is the problem that you have asymmetric information before engaging in a contract. Moral hazard is the problem of asymmetric information after a contract has been signed, and usually this, in this case, is actually a social contract. It's not a legal contract, but it's a social contract between banks and the government. Why does a bailout or an implicit or explicit bailout guarantee imply moral hazard and induce a moral hazard problem? Very simple reason for this. Yes?
If one party hides information, like liabilities or something that...
If you're a bank manager, and this is important to think of this, that these in the end are people. For example, Charles Goodhart, who is a professor at London School of Economics during the financial crisis and after the financial crisis, stressed the fact that we're not always talking about banks, we're talking about bank managers. These are people who have some interest in doing something, and imagine you are a bank manager and you know that if everything goes down the drain, you will be saved by the government. What does this imply? And how does it change your behavior? There's a guarantee that you will be bailed out. One word, or maybe two. Excessive risk-taking. If you know that you will be bailed out by government or by the central bank, this induces a moral hazard problem, because in this scenario, you will, as bank manager, you will be you will be seduced to engage in excessive risk-taking, meaning that you take on more risks than would be sensible for you, and an optimal amount of risk, because you know that if you fail, if your company fails, shareholders will be paid out by the bailout, and debt holders anyway. And if everything goes as planned, you will get a high return, because risk and return are positively correlated. So you will get high return, otherwise you will be bailed out by the government, so no problem. And this is the moral hazard problem. The social contract in this scenario is the contract that the government allows you to operate a bank, and it promises that if you engage in banking, if anything happens to you as a firm, as a bank, you will be bailed out. This is the societal contract you've entered. Problem is, as soon as you are a bank manager, you will exploit the asymmetric information that the government doesn't know what you're doing inside the bank. You'll exploit this asymmetric information, and you have the moral hazard problem that creates excessive losses in case of a financial crisis. So if you know this as a bank, you're not stupid. If you know this is a central bank, as a government, you do what? As in any case of moral hazard or asymmetric information, you try, if you're on the losing end of asymmetric information, you're trying to decrease this asymmetry. You're trying to get more information on what the bank is doing. Or you try to incentivize bank managers to stick to what is sensible, to what is good for you and what is good for the system. In other way, regulation and supervision. Government, central banks usually, or supervisors, they force banks to disclose information on their risk-taking and on their financial situation, so that government knows beforehand what is going on in the bank, and it can counteract these actions by the bank to prevent any bailout situation. And what is the best way to figure out what is the financial situation of the bank? Equity ratio, capital ratio, liquidity ratio. If you don't have enough liquidity, you're almost close to bankruptcy. And if you don't have enough equity, if you don't have enough capital, well, it's also a good indication that soon you will run into liquidity problems. That's why we always talk about capital. I think I've talked about the distinction between capital and equity. We'll come to that in a bit. But in essence, it's always about liquidity and capital ratios. Same with insurance companies. So what can you do? You can use macro-prudential approaches in contrast to micro-prudential. What is micro-prudential and what is macro-prudential? Micro-prudential, just like in microeconomics, is just taking a view on each bank as an individual and looking at each bank individually, meaning that, for example, if you're bank A and you're bank B, I will go to you, I will look at your equity ratio, at your bank account, and at your balance sheet, and if you're safe, financially sound, fine, I'll go to the next bank and see if you are financially sound. Macro-prudential, however, looks at the whole financial system. And if I see that you're individually doing fine, but if something happens, for example, in asset management, suddenly you both get into problem and my whole financial system is close to a crisis, then I have to look at the macro-prudential effects you two have on the system. And this is macro-prudential regulation in contrast to micro-prudential regulation. So you're looking at the entire financial system to limit systemic risks. This is usually what is done nowadays, because micro-prudential regulation, it's still done, of course, but after the financial crisis, regulators have become much more aware of potential risk to the system. Now, a rule-based regulation is built on quantitative norms, meaning, in the easiest example, that you simply say your equity ratio has to be higher than 8%, or your capital ratio, 8%. That's a rule-based approach in regulation, and this is tricky and can be tricky. First of all, it creates incentives for regulatory arbitrage or regulation arbitrage. What is regulatory arbitrage? Arbitrage, as you might remember, is the opportunity, the possibility to exploit differences in prices to earn risk-free profit. Go out the street, buy an apple for €1, sell it immediately to someone else for €2, risk-free profit of 1, because one good has two prices. If a market is arbitrage-free, it holds on the market holds the law of one price. That's arbitrage-free. Now, what then is regulatory arbitrage? Regulatory arbitrage is exploiting two different regulatory systems to optimize your profits as a bank or as a company. Can you give me an example? Well, you can see outsourcing of loan portfolios and risk-wire securitization transactions to external special purpose entities. Can you give me a good example of how you can exploit regulatory arbitrage? What you could do is you open up a subsidiary. I'll give you an example that might have been true a couple of years ago. I'm not so sure if it's possible today, but just imagine that you're a German bank, you set up a subsidiary in Hungary, and instead of giving out the loans via your parent company, you give out the loans via your subsidiary, which is a Hungarian company. And the result might be that the Hungarian subsidiary falls under Hungarian regulation, and if the capital ratio, the required capital, is lower in Hungary than it is in Germany, you're simply shifting some of your business into another subsidiary that falls under another regulatory regime. This has been shown to be the case. The research paper is due to Stephen Ongena, who's from the University of Zurich. And the paper is in the Journal of Financial Economics, and it's called "When the Cat's Away, the Mice Will Play." And it looks at regulatory arbitrage, I think, in Europe. There are some other examples where you can see that you can shift business out of your balance sheet into a subsidiary or some other type of business, and you're suddenly falling under a different regulatory regime. We've already talked about this a little bit when talking about systemic risk in insurance and what we call shadow insurance. That's regulatory arbitrage. If you're more interested on this question of rule-based regulation, I can only recommend to you a paper by, I think, Vikrant Vik from London Business School and Rainer Haselmann from Goethe University. They looked at the downside of rule-based regulation. Any idea why rule-based regulation might also come with some negative side effects? We are looking at a system, and in many cases, we want to prevent herding behavior of banks. So if all banks all do the same, have the same portfolio, have the same type of business, well, then all banks are vulnerable to one type of shock. And if we use rule-based regulation, this is or might create the same type of homogeneity in the system that creates vulnerability to systemic shocks. So rule-based regulation is nice if it works, but it can also come with a downside that it makes all banks similar, and the similarity creates systemic risk on its own. Same result also when it comes to valued risk regulation in a paper by Suleiman Bajak, probably Bajak, from also I think the London Business School. He shows that by forcing all banks to calculate capital based on valued risk, it again creates a homogeneity across the financial system that makes it more unstable. That makes it even less stable than thought. But you have regulatory arbitrage, and it's usually a cat and mouse game. Banks will try to circumvent regulation. Supervisors and regulators will react to this. They will close loopholes, and you can think of regulation as the outcome of a market process. You will have demand and supply for regulation, and there should be an optimum. So banks anticipate that banking supervision bodies will shy away from necessary interventions and sanctions. That means that the disciplinary effect of regulatory measures is sometimes lost. After financial crisis, it's usually the opposite. After financial crisis, you will see activism by regulators. They will act hard and come down hard on banks, and they will force banks to increase their capital. And then at some points, banks will complain so much that regulators will reduce regulation and supervision. We've seen this throughout history. So, theory of banking regulation. First aim should be, and especially in Germany this is very important, creditor and customer protection later on. Bank is not just a monolithic book with some balance sheet items, but it's a coalition of many participants. They all pursue different interests, and let's first start with management. And as you can imagine, we'll talk about management, creditors, shareholders. So in essence, managers, bondholders, shareholders. Managers, they operate on behalf of equity investors. So in the end, hopefully, they will pursue the strategies that are in the best interest of shareholders. Might not be the case, but that's at least the theory. In general, they also pursue their own purposes. They want to have a nice company car. They want to have a nice salary package. Executive compensation is very important. They will look for a nice office and so on. And in the end, also power and influence. So they will look for power over their company. Very important point when it comes to mergers and acquisitions. Why? Because this is my sandcastle, you have another sandcastle, and I want to have your sandcastle to build an even larger sandcastle. In the end, with managers, it's sometimes just about this. I have a larger sandcastle than you have. I have a larger, my Lego castle is larger than yours, and I have more power and my company is larger. Regardless of whether size is good for business and whether it's good for shareholders. So the problem is, they will prevent an intervention from the outside in the situation that we have a poor yield situation. They will try to prevent this. They don't want someone from the outside to influence their business decisions, and they might also want to conceal that the company is doing badly. What they will do instead is gambling for resurrection. Now, gambling for resurrection is very interesting. You will also see this in many other instances. What is gambling for resurrection? Gambling for resurrection. Let me turn to our friends from Canada, but I'm afraid American football is not. Do you have American football in Canada? Maybe rugby? Then you might be familiar with a Hail Mary. What is a Hail Mary?
When you throw the ball as far as you can,
Yes? Why?
because you have no other option on the play and you're trying to get the ball.
Because you're gambling for resurrection. If you've already lost, we have this in football or soccer. If you are down by 1 goal and you only have 1 minute left, you take out the goalie. This is more common in hockey, but sometimes we see this in soccer, football as well. You take out your goalkeeper to have 1 additional field player, or the goalkeeper starts running towards the opponent's goal, and they want to do something which we call a Hail Mary in American football, which is gambling for resurrection. You all put it onto one last final gamble. Why? I will discuss this in financial risk management. You can easily show in an option setting, in the Black-Scholes model, that actually in the Merton model, that gambling for resurrection can be shown to be a natural strategy that pops up if you view the firm as a put option. And why does it happen? Very simply. Is everyone familiar with the Black-Scholes model? Should be, basically. If you view the firm as an option and the firm value as the equity value as a stock option on firm value, then near bankruptcy, the option is way out of the money, which means that in this point, the owner of the option is only interested in high volatility, and high volatility is high risk. So it's natural to see that if you've already lost everything, you will gamble for resurrection. And you see this in sports, you see this here with managers, and that's their strategy. Instead of doing what is best for the company, they will gamble for resurrection. More precisely, they will do what is best for shareholders, because shareholders have already lost everything. If the company is close to default, their equity value is 0. So that's the problem here. Equity investors, their objective is the highest return on their investment, aka high return on equity. Goal is unproblematic in a situation of sufficient profit. If you earn a profit, no one cares. Regulators will not care what you do with those profits. Problem is when, again, you're close to your default barrier. When you're close to your default barrier, again, you have the same incentive as the manager, because the manager should act in your best interest. You will be looking for gambling for resurrection. Why is that? If you have 1 million in firm value and you have 500,000 in debt, first thing you need to do is pay out your bondholders, your debt holders. So 1 million minus 500,000 leaves you with 500,000. So if everything's peachy, bondholders will be paid out full and you get the residual. Now firm value drops to 500,000. Again, bondholders will be paid out first. Bondholders get their 500,000. Equity holders, shareholders, will get nothing. So as firm value decreases, at some point, when you're close to bankruptcy, and if you're only able to barely pay out bondholders, shareholders have already lost everything. Bondholders are still in the clear. They get their 500,000. So at this point, also shareholders will be looking for a gamble for resurrection. Not very nice for regulators. So equity investors will not stop managers. Problematic. External lenders, meaning bond or debt holders. Now, problem is, they will get $500,000 or euros, regardless of what the firm value is, as long as it's just higher as debt. Meaning that any additional euro or dollar in firm value, any additional amount of risk the company takes or the managers take, it all goes to shareholders. So bondholders, and again, it's easy to show this in an option setting, bondholders will look for low volatility, for low risk, because they will only be paid out the amount they've given to the company in the first place with interest. So, objective, low risk. And that's a problem. You have different incentives for bondholders and shareholders. in any company, but it's especially dramatic here in this case of financial institutions. So, in the case of highly endangered claims, lenders assume the same position as investors, since the upper limit of nominal claim is barely attainable as a whole anymore. All income will be directed to the depositors, whereas losses are borne by lenders. Therefore, what they do is they maximize the overall value of the company, and you see this in Merton's option model. If you take firm value as the underlying and look at call and put options, aka the debt holders and the shareholders, and volatility as firm risk, then you can see that here lenders and shareholders have an option claim to the company. So as long as debt capital is not threatened by default or only to a limited extent, owners and management keep control. If the default risk of depositors exceeds a critical threshold, then and only then the command and the control over the company is withdrawn and taken away from the managers and transferred to depositors. And the question now is, to what parameters should a measurement of the default risk be linked? How should we measure default risk? What good proxies do we have? And where should this critical threshold be? At which point should the regulatory body, the central bank, the supervisory agency, or just government, when should it intervene and take away control over the bank? This is what actually BaFin can do. They can rescind the license to operate as a bank, and in any country, regulators and supervisors can prevent banks from engaging in any business. Same with insurance companies. But when should they step in? This is one question. We can start with debt to equity ratio. And it's always fun to see that I actually left out the English translations for debt and equity. FK obviously is the old notation from the German script. It's Fremdkapital and Eigenkapital, so please forgive me. For those who are not German native speakers, FK is Fremdkapital, that's debt, and EK is Eigenkapital, that's equity. So what we can do is, we can start with debt to equity ratio as a measurement of the risk of going bankrupt. Take debt over equity, and the debt to equity ratio has to be lower than a certain upper limit Q. What does it mean? Don't use too much debt, or vice versa. Always have enough capital, always have enough equity on your balance sheet. Then let's take this, and debt to equity ratio is actually the starting point for many regulators. So the regulator should intervene if the threshold of the debt to equity ratio is exceeded, which means, bank, you have too much debt on your balance sheet, or you have too little equity. Okay. Now, if we rewrite this, we can write this as follows. Debt is defined as assets minus equity. If it's the debt to equity ratio, it's debt over equity. So assets minus equity over equity has to be smaller or equal than this threshold Q. Then multiply this simply. And what you can see is, it turns out that you can transform this requirement on the debt to equity ratio into a very similar inequation for equity. Equity has to be larger or equal than Q star times the assets. And this is something you might have seen or might have heard. What does it mean in practice? In practice, regulators will have some kind or some variant of this equation as part of its capital requirements. Why? Equity is capital. You might add some parts of debt, but then you simply call it regulatory capital. And on the right-hand side, you have weighted assets. And what types of weights do you use? In practice, you will have regulatory capital has to be larger or equal than risk-weighted assets. As weights, you use weights that reflect the risk of your different assets. But it's just a result of this threshold. You require the debt-to-equity ratio to not be crossed. Okay. So equity has to be higher than weighted assets. And in practice, you have some elaborate rules that allow banks to include some portions of debt. Regulatory requirements will set out the risk weights. They will tell banks how to calculate those risk-weighted assets. And that's what you do. Calculate your regulatory capital on the left-hand side, calculate your risk-weighted assets on the right-hand side, and what you get is capital requirements, capital regulation. So, what does it mean? In what amount must the risk-weighted assets on the asset side of the bank's balance sheet be backed by regulatory capital? And here you can also see the direct effect capital requirements and capital regulations have on banks' business. If you don't have enough regulatory capital, you cannot engage in more business. Or you have to increase regulatory capital, which in many cases you cannot. You know? Why? Well, if we stick to equity, how can you increase equity? By earning a profit? That cannot be done in shorthand. And what can you do else? You can do a seasoned equity offering that is increased capital, but if you're a bank, that's something that can usually be done every 5 to 10 years. Issue new shares. No one wants to buy bank shares these days. So you have to deal with the amount of capital you have, and you will use regulatory capital to back your risk-weighted assets. And if you run out of regulatory capital, or if regulation changes and regulatory requirements are increased, it means what? Usually banks will go down in business. They will decrease their business. If you think, well, this is just a theoretical idea, look at the recent paper by colleagues from the IWH here in Halle, in the Review of Financial Studies, one of the top 3 journals in finance. They show exactly this result for the increase in capital requirements in the European Union after the financial crisis. Capital requirements go up. How do banks react to this? Decrease lending. Yeah? Okay. How can you calculate risk-weighted assets? Valued risk. That's why it's so important. It's so important because you can use, and regulation allows you to use the valued risk of your different assets to calculate your risk weights, your risk-weighted assets. And this is one reason why it's so important. Yeah? So it is replaced in some cases by expected shortfall, but what you can do is, and what you see in these regulations, is that you have different portions and different parts and different regulations how to calculate your risk-weighted assets. And what you do is, for example, you have to account for normal risk, use the valued risk, and you have a stress component, let's call it that, or an extreme adverse scenario component for your capital, and you take expected shortfall because it's a risk metric and risk proxy that looks at extreme risk and tail risk. So we've seen valued risk. Why doesn't it go? The next slide. And bank regulations for risk limitation, they are usually based on these risk metrics and risk-weighted assets. And the world formula from Basel II for banks was capital has to equal valued risk of your portfolios times 8%. So take your value at risk, calculate it on the right-hand side, and it has to equal capital times 8%. So that was, in Basel II, the way of calculating capital and risk-weighted assets. And as value at risk is a downside risk measure, it proxies for financial losses, and it gives you exactly this idea that your regulatory capital, in the worst of cases, has to be used to cover financial losses on your asset side. Because otherwise you will go bankrupt. Okay. Someone doesn't go to the next slide. Now, before that, before Basel II, and before value at risk was introduced into bank regulation, the amount of assets actually was fixed and the required equity capital was determined. And if you look at the different regulatory regimes in the world, you will see all different types of capital requirements. For example, in the UK, you don't have fixed rules for all banks, but regulators set capital requirements individually for each bank within a certain range. You will see individual capital requirements for individual banks, and as I've just told you, this mandatory minimum amount of equity, it will have an effect on business and the growth of a bank. If you have binding constraint coming from your capital requirements, you will not extend lending. You will not engage in additional business. You might be even forced to sell off business. Okay, seems this doesn't work. What are some problems with equity and assets? Problem is, first of all, the risk to creditors and deposits depends on actual risk. Therefore, it makes sense to weigh your asset and to use weights based on the risk you have somehow calculated. Problem is, if your risk measurement and if risk management isn't up to the task, it might be that you have calculated your risk-weighted assets too high or too low. So this is why regulators will also look for proper risk management in banks, because risk management is the starting point to calculate your risk-weighted assets. And this is also why risk management is mandatory in banking, and why supervisors will look and assess the validity and quality of your risk management in a bank, because it's needed for calculating the risk-weighted assets in capital requirements. And risks of individual investments are less important than the risk of the overall portfolio of investments. And again, you might have measurement problems. We talked about this problem that value at risk is not coherent, that it doesn't adequately address correlation and diversification effects. And this is a problem here, because if you have a portfolio and value at risk doesn't properly pick up diversification effects, you will not have an adequate measurement of your overall risk, and then capital will be too high or too low. If it's too low, that's a problem for regulators, and they will prevent that. If it's too high, well, that's okay, but if you have too much capital for too little business, you have too high costs of capital. Equity is expensive, and the result will be that your cost of capital will explode. So banks, I forgot to tell you this, but this is true for any company. No one wants to operate at 100% equity. Debt is cheaper. So if you can use leverage, there is an optimal capital structure in practice. We know this from the results in corporate finance, that there should be an optimal capital structure, and it will definitely not be at 100% equity. So banks and bank managers will have an incentive to keep equity low, because otherwise their cost of capital will be too high. But then if equity is too low, capital is too low, and regulators will step in. Now, assets should not be limited only to balance sheet assets, but to all risky positions. Then, what should you use? Market values, book values. What we will later on see is that capital needs to be called regulatory capital because it includes equity and some parts of debt. Which parts of debt would you include in regulatory capital? Any idea? Subordinated debt. In German, nachrangige Verbindlichkeiten. Why? Why would you include subordinated debt to some extent in your regulatory capital? The defining property of subordinated debt is what? It does not need to be paid back at the same time as, let's call it regular debt. The idea behind subordinated debt is that it is somewhat closer to equity than debt. Say this in German again. Bei nachrangigen Verbindlichkeiten ist ja gerade die Eigenschaft, die Definition, dass sie nachrangig bedient werden. Also nicht sofort im Falle der Insolvenz, sondern erst nachrangig. Ist natürlich schlecht für denjenigen, der es vergeben hat, aber der bekommt auch dafür eine höhere Verzinsung. So, investors in subordinated debt get higher interest. But if, in the case of bankruptcy, some parts of debt, like subordinated debt, are dealt with just like with equity, then it's okay, at least to say, for example, take subordinated debt times 50% and include it in regulatory capital because it will not force you into bankruptcy at once. No? So, in many cases, we'll see regulations that use book values. Some regulatory systems use market values. You will see subordinated debt, some parts of debt being included in regulatory capital. One could argue that market value is better suited to indicate the default risk of creditor claims, but this brings us to the problem of fair value accounting. What is fair value accounting? Well, you are a slow crowd, I have to say. What is fair value accounting? Slow evening here. Fair value accounting means that you mark to market your positions on your balance sheet. That is, you take market values instead of book values or initial cost values. Hm? Fair Value Accounting bedeutet nichts anderes, als dass Sie nicht zu Anschaffungspreisen, sondern zu Marktwerten bewerten. This means if you use fair value accounting in regulation, and if you have a sudden drop in market value, as seen in the financial crisis with subprime mortgage loans, portfolios, you need to do what? Marking to market means the value of those assets decreases, meaning that you have depreciation or write-offs. Those write-offs will decrease your book value of equity, and the result is bankruptcy. Even if at some point in the future you will be able to sell off these portfolios at a fairly good price, fair value accounting will force you into bankruptcy way before you are able to sell off those portfolios. This happened to many banks during the financial crisis. They had to apply fair value accounting. Those loan portfolios in the subprime segment at some point were illiquid, thus worthless, thus had to be written off. Those write-offs caused billions and billions of dollars in losses, depleted the regulatory capital, and those banks went bankrupt overnight. Nowadays, the bad banks that are in charge of selling off those loan portfolios, they get more than just zero. They get a fairly good price on those loan portfolios, but now it's 15 years later, or 12, 14 years later. So there are some ups and downs to using fair value accounting or just using book values, and you need to think about this. What is the intention of a risk limitation standard? Well, the alternative motivation is you want to avoid moral hazard problems. You want to avoid moral hazard problems, so exogenous risk should not lead to the loss of management control over the bank, And again, we can make a distinction between macroeconomic and idiosyncratic or company-specific risks. And only company-specific risks should be included in our risk limitation standard or in our capital requirements. The purpose now is we have to form and to build a capital buffer for losses. We'll see this later on in more detail. Actually, nowadays, modern regulatory systems, they include all types of capital buffers. Just a baseline buffer plus a systemic risk buffer if you are systemically relevant and so on. And this is how your capital in the end looks like. But in addition to risks that directly lead to losses, you also need to think about liquidity risks. So this is a little bit of theory. So let's then start to talk about systemic risk. I don't remember who said this, but in one research paper, there was a nice analogy to something you probably know. I think it was a man, probably a man, of course. He said, systemic risk is pretty much like porn. You cannot define it, but everyone knows it and recognizes it as soon as you see it. And this is a problem. Systemic risk are defined as risks that, at least in this definition, are per se not identifiable at the individual bank. They don't seem controllable. And they cannot be compensated by simply aggregating all risks across the banking sector, because they are also mutually enhancing and mutually increasing. And this is a problem. Systemic risk is very hard to define. There is one definition. This is alternative definition 1 given by the G10 at the time. A systemic risk is a risk that an adverse shock causes and a significant loss of economic value in a sufficiently large number of banks, and that this loss of value has a negative effect on the real economy. I've seen people use this definition of systemic risk and apply it to the insurance sector. Why? Because it's probably the most general definition you will find. First of all, it's anything adverse that happens to the financial system. It causes problems in the financial system, but it needs to have an effect on the real economy. If it stays in the financial system, we don't have to care. That is one argument. And for banking, no one would think that this could not have an effect on the real economy. But if you think about systemic risk in insurance, the idea is that you take the same definition and you look for effects on the real economy. And this is not trivial. Why? Because in many instances, insurance managers will just say, when it comes to regulation, we're not systemically relevant. Let the whole insurance sector go down the drain. Let it all go bust. No one cares. Policyholders will be paid out. People will look for different companies to get insurance. And at least in some countries, you will see that they don't have an insurance sector. If you look at third world countries, you will see that there are no insurance companies. I wouldn't argue that this is not value enhancing, and obviously it has a positive effect on welfare, but it's difficult to find hard empirical evidence on the real effects of insurance, because we all want it, that's for sure. But it's not as evident as with banking. With banking, you can always argue banks, financial system, payments, lending, firm investment, employment. Yes, direct effect, direct channel on firm investment and employment and economic growth. With insurance, it's a little bit more tricky. At this point, you might ask yourself, well, that's very pessimistic of me to argue that no one cares about insurance. I can tell you this. Why? Because actually it's the insurance managers themselves who use this argument. Why? They want to prevent politicians to think about harder and tougher supervision of the insurance sector. When it comes to regulation, You will hear CEOs of insurance companies say, oh, we're of no importance. Let us go bankrupt, we don't care. Yeah? Before thinking about capital requirements and higher capital requirements, let's let the whole insurance sector explode. Yeah, that's okay with us. I heard this argument from the CEO of the world's largest reinsurance company. At that point, he just said, if we go bankrupt tomorrow, Warren Buffett will have a problem, but the result will be that no policyholder has a problem and all our business will be taken up by our competitors. No systemic relevance at all, no effect on the real economy. Maybe a little bit too simplistic, but that's their argument. You know? So in the insurance sector, it does make sense to think about this definition a little bit more. You will also find different arguments and different definitions. These are three names you should remember when you come out of an economics bachelor and definitely master's degree. Tobias Adrian is, if I'm not very much mistaken nowadays, the chief economist of the IMF. He used to be at the Federal Reserve Bank of New York. Markus Brunnermeier is the financial economics professor at Princeton University. And Viral Acharya is a professor of finance, now back again at NYU. He left NYU for a couple of years to become the vice governor of the Reserve Bank of India. So he was a central banker at some time. He left India a couple of months ago because he's highly critical of the current prime minister's policy and stance on monetary policy. So he's left the Reserve Bank of India, the RBI now, and is back at NYU. Oh, sorry, I should talk about the definitions. In their works, and they've done a lot of work on systemic risk, they argue that a bank's systemic risk contribution is the amount that an individual bank contributes to potential undercapitalization of the entire financial system. So what they do is they argue about systemic risk in a more detailed way, arguing that systemic risk can be put into a dollar figure. In the end, it's the amount of capital, the amount of money the government or the central bank has to pump into the financial system to save it. They don't care about the effects. They don't care about how this comes about. They only argue that systemic risk is the amount of capital, the undercapitalization of the whole system, and the systemic risk contribution of one bank is just the effect one bank can have on the undercapitalization of the whole financial system. Couple of pretty important and very interesting papers on systemic risk. Now, exogenous shocks are usually just the triggers of a crisis. The crisis scenario itself arises from the bank's reaction to this shock. And it is very interesting and also frustrating to see that almost all banking crises and financial crises follow a certain pattern. You will have one initial shock, and you will never be able to prevent this. There will always be surprises to investors in capital markets, be it Lehman Brothers, be it some type of bubble in the market for tulips in the Netherlands in the 17th or 16th century. Tulips, Lehman Brothers, housing market, war with Iran, last week's news, could be anything. So there will always be an exogenous shock, and banks and more generally the financial markets will react to this adverse shock. You will see some reaction. Problem is, individual banks do not consider the effects of their actions on the stability of their financial system. Prototypical example, Lehman Brothers, all banks refrain from lending in the interbank market. We saw a run on repos, repurchase agreements, money market instruments with which banks grant loans to each other. So you had a contraction in the repo market, a run on repos, and this was okay for the individual bank. The result for the system was liquidity problems for all major banks. And the solution, in addition to micro-prudential supervision, is macro-prudential supervision. Micro-prudential supervision is looking at banks individually, making sure they have enough capital, they have enough liquidity. But if suddenly all banks have enough liquidity based on the proper functioning of the interbank market, and then you see herding behavior, that they have a run on repo, the problem might be macro-prudential in nature, and then you need macro-prudential supervision to prevent this or to counter this effect. Macro-prudential supervision should be clear by now. If you only look at the financial health of an isolated institution, you get micro-prudential. If you look at the system as a whole, you get macro-prudential supervision. Test question: who does micro-prudential supervision in Germany? Who does macro-prudential supervision? In theory, everyone. BaFin, Bundesbank, and European Central Bank. Who does it in practice? Micro-prudential supervision is done by Deutsche Bundesbanks, local offices. Here, Leipzig. They do micro-prudential supervision. They look at the bank's balance sheet. The data is transferred, and the results are also transferred to Bundesbank's central headquarters in Frankfurt. Bundesbank has divisions on financial supervision, financial stability, and what does European Central Bank do? They are in charge of macro-prudential supervision of systemically important European banks within the European Union. So you can argue that more or less the day-to-day ongoing, as we call it, the ongoing supervision of banks is Deutsche Bundesbank's micro-prudential supervision, whereas the headquarters in Frankfurt and the European Central Bank, they are more concerned about macro-prudential supervision. Wir haben ja gesehen, dass die Bundesbank und die BaFin sich die Aufsicht in Deutschland teilen. Bundesbank macht die laufende Aufsicht. Und die laufende Aufsicht, das ist in der Regel das, was die Bundesbankprüfer hier vor Ort in Gestalt der Hauptverwaltung in den örtlichen Sparkassen, Volksbanken und den einzelnen Bankfilialen machen. Das, was darüber hinausgeht, macht die Bundesbankzentrale, die entsprechenden Einheiten und Abteilungen und Bereiche für Finanzmarktstabilität und die EZB. Okay. Observation: granting of credit by banks runs cyclically to the economy. Ergo, there is a large discussion that has evolved after the financial crisis. You can see most of it is due to the financial crisis. It was a pretty bad experience for everyone. You can think about anti-cyclical regulation and pro-cyclical regulation. What do you think is better, pro or anti-cyclical? And what does anti- and pro-cyclical regulation mean in this context? Pro-cyclical means what? Well, you have the definition of anti-cyclical. Pro-cyclical is the bad thing, or people, researchers argue that it could be bad, and it should be bad. It means that if you have a crisis, you toughen up. You use tougher supervision, you increase capital requirements, and that's what we are doing right now, or what we have done after the financial crisis. Oh, the bad banks, banks were bad, we need to increase capital requirements. Problem is, you are in a crisis and you suddenly get tougher on banks, and we've talked about this. Higher capital requirements means less opportunities for banks to engage in lending, and this means crisis, economic crisis, bank contract lending, less loans, less investment, more unemployment, even worse crisis. So banks go down, economies go down, and you have an even stronger effect on economic growth. Anti-cyclical regulation is you are strict during the up times, during the boom cycle, and as soon as you enter a bust cycle, a bust phase, a recession, you loosen up regulation because you want banks, you want to incentivize banks to give out more loans. And this is anti-cyclical regulation. And nowadays, I would say that researchers would probably agree on using anti-cyclical regulation, because otherwise regulation can worsen a recession and it can worsen a financial crisis. Okay. Further approaches in regulation are based on the too big to fail effect. What does it mean? If you are too big to fail, it means that you as a whole, as an individual bank, you are too big to fail. If you go bankrupt, you will drive the whole financial system down. If you know this, and usually you do know this, if you're Deutsche Bank, if you're JP Morgan, if you're Bank of America, you are systemically relevant, you are too big to fail, you will exploit this. Bank managers will exploit this. And this provides an incentive, again, for excessive risk-taking, and they know that in case they have taken up too many risks, they will be saved from insolvency by regulators. Okay, so what you do is, for those banks that you deem to be systemically relevant, you increase capital requirements even more. This is why, for example, the regulation and supervision of systemically relevant banks has been transferred to the European Central Bank, with the effect capital requirements going up again. That's a very simple idea here. What are the criteria? There's a missing I here. What are the criteria for systemic importance? Size, effect on the real economy, cross-border activities, cross-linkages with the financial system, substitutability with respect to offered financial service, and complexity. Now, Deutsche Bank, take for example Deutsche Bank. Deutsche Bank has a huge number of subsidiaries in different countries, and it's just a huge mess to think, and if you were to disentangle all those business connections and all those subsidiaries. That is meant with complexity. Cross-border activities and cross-linkages with the financial system are, I think, quite clear. What is substitutability? This is actually also one criterion in the systemic risk measurement for insurance companies. Substitutability of the offered services. What does it mean? You're one of a kind, and if you go bankrupt, no one else is able to offer these services. This might be a major concern in the future if, for example, let's say Facebook starts Libra, and if in a couple of years Libra becomes the next main currency of the world, then obviously it's systemically important and it's systemically relevant, because if Facebook fails from one day to the other, if it becomes bankrupt, who manages Libra then? Same with some other companies nowadays. In some segments, you just see that you cannot substitute this firm with another. This was the same argument with some reinsurers, but regulators accepted the argument from companies that even the larger reinsurance companies could be substituted by their main competitors. Let's say, for example, Munich Re and General Re and Swiss Re. You have three main competitors in reinsurance, and you could even argue that even a company like Munich Re, Münchner Rück, could go bankrupt and its business would just go to Swiss Re, General Re, and some other reinsurance companies. Huh? So these are some criteria for systemic importance. How can you measure systemic risk? There are several measures in the literature. COVA, delta COVA, the marginal expected shortfall, S-risk, and so on. If you Google these names and these abbreviations, you will immediately find the research papers written on these measures. If you're more interested in this, we'll talk about this in, I guess, all the seminars, both at the master's level and the empirical banking and finance seminar. I will not go into too much detail here, but rest assured there are several measures that have been proposed after the financial crisis to measure risk, systemic risk. Problem is, they're not very good. There are some papers that clearly show that, I mean, we're asking too much from statistical measures and statistical metrics here. If I were able to forecast the next financial crisis, and if one of these proxies had out-of-sample forecasting accuracy, I would be a crash prophet and I would be writing a nice book and earning some millions of money by selling books, telling people when to sell their stocks beforehand. I think this is asking too much of simple statistical moments and metrics to forecast systemic risk. It might be that these metrics have in-sample forecasting accuracy, but still, at least for marginally expected shortfall, it famously failed to, after the crisis of course, it famously failed to identify American International Group as a systemically important financial institution. It didn't pop up here in MES, at least that's what some papers say. Okay. Questions up until this point when it comes to capital regulation, the motivation behind regulation, macro-prudential, micro-prudential regulation, anti- and pro-cyclical regulation. Those are just terms you should be familiar with when talking about bank regulation. Okay, and let's turn to the development of the regulatory framework. Now, in almost all countries, it all started in the 1930s. Why? We had the Great Depression in Europe and United States, and as a result, many banks failed. Back at that point, in many countries, we didn't have deposit insurance. At some points, we didn't even have bank regulation or supervision. Banks and financial institutions could do all they want, and during the Great Depression, governments and politicians saw that banks needed to be regulated. So this is when it all started, and what the result was that because of the default risk for depositors who lost their deposits with deposit insurance being absent, regulators were put in place, and they looked at default risk, market risk, liquidity risk, later on operational risk, and large individual credit risks. Risk limitation is implemented by capital requirements, equity requirements. When it comes to risk management, we'll later on talk about the minimum requirements on risk management in Germany, which is MA-Risk, MA-Risk, Mindestanforderungen an das Risikomanagement. They are mandatory for banks and in a slightly different way also for insurance companies, which means that risk-bearing capacity must be given and an appropriate business organization and appropriate risk management must exist. This is also mandatory for industrial firms. Any idea when industrial firms have to keep an appropriate risk management and why? Almost 25 years ago, German Parliament changed the German Stock Company Act, das Aktiengesetz. what did it do? It introduced regulations concerning corporate governance. Before that, we didn't really care about corporate governance, but then some parts were introduced in the German Stock Company Act. It's Deutsche Aktiengesetz. What was introduced? There is a name to that law that changed the Aktiengesetz. And that name of the law is Contract. Das Gesetz zur Kontrolle und über Kontrolle und Transparenz im Unternehmensbereich. Contract, in English, the act concerning control and transparency in the corporate world. If you were to translate it literally, it changed certain parts of the German Stock Company Act. And what it said that nowadays says that management is required to install proper risk management and to control and monitor any risk that might endanger the safety of the firm. It's not as elaborate as the MA risk or any regulation concerning banking, but any company, any industrial stock company under German law is required, or management is required, to monitor any life-threatening risks to the company. Ja, da steht also drin, ne, das Management muss alle existenzgefährdenden Risiken überwachen und muss ein entsprechendes Kontrollsystem einführen. In many cases, this only means that they will include a small section in their annual report on risk management and just say there are no bankruptcy threatening risks identified in our company. We are not exposed to any large risks, full stop. That's it. This wouldn't do in a bank, but even industrial firms have to do this. Now, when I say industrial firms, in some cases it might be that these companies also have a risk management that is as detailed, as complicated, and as elaborate as it would be in a financial institution. Any idea which companies run an almost bank-like risk management? Energy companies, E.ON, RWE, NBW, Vattenfall. Energy companies, because they're exposed to huge amounts of commodity and market price and credit risk and operational risk, they will also be forced under German stock company, under German corporate law, they will be forced to install risk management. It's not due to banking or financial regulation, but it's simply due to the fact that they are exposed to bankruptcy threatening and existential risks. Also, schön merken, Contract gilt für jedes Unternehmen, für jede Aktiengesellschaft, mit Strahlkraft auch auf GmbHs. Ja. Und damit müssen Sie auch immer ans Risikomanagement denken. Wenn Sie keine existenzgefährdenden Risiken haben, brauchen Sie kein Risikomanagement. Aber ein Unternehmen wie E.ON oder RWE, das den ganzen Tag nur mit Risiken arbeitet, die haben natürlich ein bankenähnliches Risikomanagement. Da aber nicht aufgrund der Bankenregulierung und der Finanzmarktregulierung, da hervorgerufen durch das Aktiengesetz durch das Contract abgeänderte Aktiengesetz. Okay. And in addition to regulation on risk management and capital requirements, at some point in time we also will see, I have to say this is a bad translation, strike out settlement and reorganization. What is meant with this rather crappy translation from me from German to English is what? Any idea? It's banking resolution. I guess I used the wrong translator. I used the wrong machine learning algorithm here to translate Bankenabwicklung. What does bank resolution means? Or German Bankenabwicklung. It means that nowadays regulators require most banks to have a living will. And what is a living will? They need to have a plan in place according to which the bank will be resolved in an orderly fashion in a bankruptcy, so that the bankruptcy will not have adverse effects on the financial system. The banks should be allowed to go bankrupt, but the bankruptcy should be done in such an orderly fashion that it does not endanger the whole financial system. So this is bank resolution. And you will have regulations concerning reorganization, restructuring, and resolving banks. Bank resolution and bank restructuring. Okay. And you will have deposit insurance, and sometimes deposit insurance is mandatory, sometimes it's voluntary. For example, in Germany, you will see for many of the three pillars, state-owned, government-owned banks, cooperatives, and private banks, you will see in a deposit insurance scheme for each of these three pillars, and they will usually have what is mandatory under German law plus some extra. So you will have different layers of deposit insurance. Okay. In Germany, as you can see, it already started before that, started in the 19th century with the Berliner Bankenpanik, bank panic amongst depositors in Berlin. Then banking supervision started in 1899, as did so many things in that era. Social security, for one thing. And as for a very long time, actually, we've had freedom of trade, Gewerbefreiheit. At first, general banking supervision was rejected. Why? Because it's a limitation on the type of business people can do, banks can do. In 1931, we had the decree of the first general banking supervision by emergency ordinance, emergency executive order of 1931. This sounds strange a little bit. I hope the German students know about this. You should, yeah, you should know. For you exchange students. Back at that time, at the end of the Weimar Republic, German politics were virtually, how shall I put it this? Governments were no longer able to function properly because of shifting majorities and because of increasing power of the Nazi Party. So what happened is the constitution of the Weimar Republic allowed the government to rule by using executive orders. Those were only meant for times of crisis, but the governments, even the democratic governments, in order to keep the country running, they used executive power and the executive orders that were only meant for times of crisis and revolution to keep the country running. And this was still done by what we would consider a democratic government, and 2 years after that, Nazis took over. So this was installed during the Weimar Republic, and as it was a case in all throughout history, all pieces of legislation concerning bank regulation have always been enacted as a result or as a reaction to a crisis, to a bank failure, to a bank panic or whatsoever. In this case, it was the closure of the Darmstädter und Nationalbank, also called the Danat Bank, was closed as a result of the Great Depression, and we installed our first general banking supervision at that time. So that's usually the way it goes. You have a crisis, you have a bank run. A bank run is a situation where you as customers run to your local bank, you take out your deposits, or you try to take out your deposits, and you force this bank into bankruptcy. The first bank falls, then other depositors at other banks will see this, they will also run, you get a panic, and the whole financial system, the whole banking system at least, comes down. Run to the bank counters, introduction of an ordered bank holiday. This is the very definition of a bank holiday. You might know this is, how do you call this as well in Canada? Bank holidays? Public holidays in the UK are called bank holidays. So if you were from the UK, you would know that public holidays actually are referred to as bank holidays. And you can look at this from two sides. You can argue that if the bank is closed, then it's also a public holiday. Or actually here, a bank holiday, and we have the same word in German, Bankfeiertag, but we never use it. A bank holiday is a holiday that is forced onto banks by supervisors because they are closing down the offices, the branches. The bank is suddenly closed down because they are fearing that depositors could run. The last time we've seen this was in Greece, when people started to run to ATM machines and to bank branches, and government closed down and limited the amount of cash that was dispensed from ATM machines in Greece. That's a bank holiday. And this is still today possible under paragraph 46 of the German Banking Act. Paragraph 46 KWG erlaubt es der BaFin, einen Bankfeiertag einzuführen, was nichts anderes heißt, als dass die Bank an dem Tag geschlossen wird, zwangsweise. Deswegen, man muss dann immer schauen. In Großbritannien heißen die Feiertage heißen einfach Bank Holidays. Also wenn Sie da zum Beispiel jetzt den 1. Mai haben, dann ist das ein Bank Holiday, was einfach nur bedeutet, dass es ein Feiertag ist. Here in 1934, the first law concerning the German banking sector was enacted. And this at that time was the Reichsgesetz über das Kreditwesen, and in 1962 this was replaced by the KWG, the German Banking Act we still have in place today. And you can see that this happened over time. Now, also a phenomenon we always see in regulation: regulation, deregulation, re-regulation. A crisis occurs, you have regulation. At some point, people forget about the crisis, and banks and lobby groups complain a lot. Then you get deregulation. If you deregulate too much, you get the next crisis, and then again re-regulation. Same here. So in 1974, we had to close Bank Herstatt. Nowadays, no one remembers this, but that bank and this closure of this bank, at the time, there was a national crisis. So deregulation phase, especially during the times of stark economic growth after the Second World War, deregulation. Then in 1974, Bank Herstatt went bankrupt. Consequences, we had Grundsatz 1, Principle 1, or Principle 1A of the German Banking Act. We expanded deposit insurance. We established a 4I principle in management, pretty standard, but not until that time. And we tightened regulation for large credit. I might have mentioned that Bundesbank keeps a register, a credit register of large and million euro credits and loans. Die Groß- und Millionen-Kreditnehmerstatistik. Meaning what? If you take a loan in excess of, say, 1 million euros from a German bank, the bank is required to report this, and of course not openly, and it's not open to the public, but privately, to Bundesbank, and Bundesbank keeps a credit register to keep track of all those large loans given out to from German banks to German companies. This is what is meant by tightening regulation for large loans, and large credit is a bad translation again. It's a large loan. Grundsatz 1. It limited foreign exchange positions, and actually it's interesting to see this example of Herstatt. Herstatt went bankrupt because of speculating with commodities, with steel and foreign currencies. It didn't went bankrupt because of the loans. It went bankrupt because it speculated too much with commodities. So as you can see, the result in the Principle 1 or Grundsatz 1a, the result was that supervisors and regulators looked at regulating and limiting market risk. We did think about subprime loan mortgages at that time. We were more concerned about limiting positions and open positions in precious metals and foreign exchange risk. Yeah? And today, this is basically interest rate risk and price risk. And since the 80s, German banking supervisory law has been changing at shorter intervals. Why? Well, because now it's done at a European Union level. It's no longer just national, but it now reflects regulation at the EU level. And this is why almost all German bank acts and regulatory provisions have been changed a lot since at least the financial crisis. Okay. I've used up my time now, so I think this is a good point to stop. Do you have any questions concerning this first part on bank regulation? If not, you can see that next we'll move on to European Communion and European Union regulation. And 2004 is one major milestone in banking regulation when it comes to Germany and the European Union, Basel II. Back at that time, I still remember that because I did my diploma in 2006 when I graduated. Back at that point in time, if you had Basel II on your thesis, in your thesis title, or at least once on your graduation paper, you had a job guarantee. All the banks were looking for people who had some knowledge of Basel II because it was the main thing back at that time. Then it was Basel III and so on. Same with insurance companies. A couple of years ago, if you had done some work on Solvency II, you could get any job in an insurance company. Solvency II was a new Basel II at that point. Okay. If you don't have any questions, thank you for your attention and see you next week. Thank you.